Indian equity markets have navigated a volatile January 2026. The Nifty 50 and Sensex slumped nearly 4% in the first half of the month, but recovered some of those losses following the announcement of the India-EU Free Trade Pact. The downtrend is fueled by relentless foreign portfolio investor selling. Overseas funds offloaded a net around $4 billion in January. However, domestic institutional investors provided a sturdy floor by absorbing some of that selling pressure. Now, with the union budget set for February 1st, the market's focus has shifted to stimulus. Markets are looking at possible tax rationalization that could reward investors to stay anchored in India. Analysts are also expecting a fiscal deficit target of 4.3 to 4.4%, as it could balance growth and stability. And one of the key areas for investors is the government's divestment target. Any commentary or clarity on the government's stake sale in firms like Shipping Corporations of India and Hindustan Zinc could provide the government additional revenue without having to borrow. As the countdown to the budget enters its final lap, markets are expected to get increasingly volatile. But whether markets enter a bull run in 2026 or not depend heavily on the government's narrative around these key terms is something that we'll have to wait and see. And for more on this, we're now being joined by Mr. Ajay Bagga, market expert, who is joining us live from Mumbai. Welcome to the broadcast, Mr. Bagga.
Thank you.
So Indian stocks are on track for their worst start of the year in a decade, and foreign investors have been turning net sellers. And having said that, do you see that the budget is going to address these concerns?
Well, there is a lot of hope that the budget will bring in some measures which will help the markets. But we must realize that right now there is no political capital as such to be spent. So overall, there is no imminent national election. We are not expecting big bang kind of reforms in the budget. So it could be a non-event, and we will have to wait for an earnings recovery in the Indian markets. That might be the issue, and the budget could turn out to be a non-event.
Right, and India's $360 billion tout, they raised billions, they raised the stakes for the budget. Now, what do you expect from the budget to lure foreign investors?
Yeah, see, what are foreign investors looking for? They want a continuity of a policy regime, not a rejigging of tax rates on a yearly basis. So that is one. Secondly, they want a competitive tax regime. So in line with what they are paying in other jurisdictions. Third, they are looking for growth, which we are providing. We have rule of law, protection of property and growth. But what we are lacking, one is our valuations are too high. So earnings have to justify those valuations. Second, artificial intelligence is what has been seeing most of the incremental flows. And we don't have anything as a pure play artificial intelligence or semiconductors play to attract foreign investors. These are the two big issues: valuations, artificial intelligence, and the third one being tax policy, which is laid down for the next 5 years and not tinkered with on an annual basis.
Right, and will the government look to speed up share sales in state-run companies to bolster the revenues after last year's income tax and GST cuts?
See, that is the hope, but the track record is very patchy. So government has underperformed in terms of what it has been able to disinvest. It is a huge value unlocking that is possible. I'll give you a small example. In 2002, government sold its stake in Hindustan Zinc, a metal miner, for about 770 crores. And the government retained a 29% stake. Since 2002-2003, the government has earned 32,000 crores as dividends for the stake that it has retained in the company. The company has gone up in market capitalization from 1,800 crores to 3 lakh crores. The government today owns 90,000 crores in that company in terms of market cap, where it used to own 1,000 crores in 2002. So that is the kind of value unlocking that is possible. There is no reason for the government to be sitting 96% in LIC or more than 70% in so many public sector companies. The two options for the government: one is retain voting rights. So have a golden share, which gives you the majority voting rights if you are concerned about that. Second, provide a guarantee for the rating for these companies so they can continue to raise money on the cheap from the markets. Those are the two big issues. Otherwise, there's 40 lakh crores worth of government stake in the stock market. At least we can generate 1 lakh crore a year by selling strategic stakes. We have seen Hindustan Zinc, we have seen Neelachal. Neelachal Ispat was a defunct company not producing for 2 years. The country was losing out where a steel plant was not producing. Tata's took it over. Now that company has made 1,000 crore profit in the last year. And look at the market cap where it's gone. So we have these options available. I think this needs to be looked at, but given the track record, I don't have too much optimism that the government will deliver on that front.
Right, of course, we'll have to wait and see how the government addresses these concerns. But for now, thank you so much, Mr. Bagga, for joining us on the broadcast and sharing your insights with us.
Thank you.